All right, let's talk about something that every single investor, whether you're in crypto, stocks, or commodities, absolutely dreads. Imagine waking up one morning and the very things you bought to keep your money safe are at the epicenter of a financial hurricane. A day when everything you thought you knew about a safe investment gets turned completely upside down.
And look, this isn't some hypothetical classroom discussion. This really happened, and it forces us to ask a really uncomfortable question. What do you do when the financial shelters you run to for cover are the first ones to get blown away in the storm?
On this one single day, gold, the bedrock of financial security for literally thousands of years, took a nosedive. It dropped a staggering 17%. To put that in perspective, a move that big should take months, maybe even years to play out, and it happened in a matter of hours.
But wait, it gets crazier. Silver, which is kind of like gold's wilder younger brother, did something that was just unthinkable. It crashed by nearly a third of its entire value. 30%. Poof, gone.
So what was the total damage? A combined $5 trillion in value just evaporated, wiped off the books for gold and silver. That is more than double the entire market cap of Bitcoin at the time. All of it, just erased in less than 24 hours.
Okay, so let's get into the weeds here. The date was January 29th, 2026. What the world saw that day was one of the most brutal, historic collapses in the history of precious metals. And we're not talking about some risky tech stock here, right? We're talking about the assets that people run to when things get chaotic. And they didn't just dip, they completely fell apart.
So you have to be asking, what on earth could cause that level of panic? Was it a massive bank failure? Did a war break out? Nope. The trigger was actually much quieter, but way more powerful. It was a single political decision made about who was going to run the US Federal Reserve.
Now this is where it gets really interesting, so pay close attention. The market had priced in two totally different realities. Everybody, and I mean everybody, was betting on Kevin Hassett getting the job. He was seen as a dove, a guy who would prioritize growth, probably by keeping rates low, which generally means a weaker dollar. But in a complete surprise move, they chose Kevin Warsh. He is a known hawk, a market disciplinarian who is expected to protect the Fed's power and strengthen the currency. The market had bet the farm on one outcome and suddenly got its polar opposite.
And the market's reaction? It was immediate. The second the news broke that Warsh was the guy, the US dollar index just shot through the roof. Why? Well, because a strong, independent Fed means a stronger dollar. And there's a fundamental rule in markets. When the dollar gets stronger, assets that are priced in dollars, like gold and silver, almost always go down. It's like a seesaw. Dollar up, gold down.
But let's be clear here, that Fed decision, that was just the spark. The real problem was that the entire market was like a forest soaked in gasoline, just waiting for a match. The conditions for this kind of catastrophic collapse had actually been building up for weeks.
And this chart just illustrates the problem perfectly. In the weeks right before the crash, gold had already shot up over 20%. Now, for an asset that normally moves about 12 to 15% in an entire year, that is a massive red flag. It's a classic sign of a speculative bubble. And silver? It was even worse, up over 40%. This wasn't careful, long-term investing. This was a flat-out frenzy. So to really get what happens next, we have to talk about something called a margin call. Let me break it down simply. It's basically when you borrow money to make a bigger bet, and that bet goes horribly wrong. Your broker calls you up and says, hey, your position is collapsing, you need to give me more cash right now or I'm going to sell everything you own to get my money back. It's not a suggestion, it's forced selling. And that right there is the key. The news about Warsh and the stronger dollar started the initial sell-off. But because so many traders were using borrowed money, they were over-leveraged, that first little price drop started triggering margin calls. That led to forced selling, which pushed the price down even more, which, you guessed it, triggered even more margin calls. It became a mechanical death spiral, a liquidation cascade that just fed on itself, getting worse and worse with every tick down. But the fire didn't stop there. It wasn't contained to just the traditional markets. As everyone's confidence in the so-called safest assets on the planet just vaporized, that shockwave spread, and it spread fast, right into the world of crypto.
So why did Bitcoin, which so many people call digital gold, follow physical gold right off a cliff? Well, it wasn't because of a hack, or a bug in the code, or some problem with the Bitcoin network. Nope. The reason for the crash was almost identical to what we saw with gold. This wasn't about Bitcoin's fundamental value, it It was a brutal lesson in how fragile the over-leveraged market built on top of Bitcoin had become.
You see, the crypto derivatives market was just as overheated, if not more so. So much money was tied up in speculative futures contracts, basically paper bets on the price instead of in people actually holding spot Bitcoin. So when the panic hit, the exact same liquidation cascade that wiped out the metals traders started wiping out the leveraged crypto traders. It was the same vicious cycle of forced selling, just in a different asset class.
So if it wasn't really gold's fault or silver's fault or even Bitcoin's fault, then what was the real villain in this whole story? When you connect all the dots, the crazy events of that day really boil down to one powerful, timeless lesson that every single one of us needs to understand.
The problem was never the asset itself. The problem was the market's addiction to leverage. Everything was dominated by paper positions, futures, options, bets made with borrowed money, instead of people actually owning the underlying asset. And here's the bottom line. There is no such thing as a safe haven when you're drowning in that much debt.
And that's really the fundamental difference, isn't it? True investing is about owning something for its long-term value. But when a market gets completely saturated with leverage, it's not an investment vehicle anymore. It becomes a giant, high-stakes casino where everyone is just gambling on tiny price movements. And as we all saw that day, when the house decides to change the rules, the entire casino can come crashing down.
Look, the crash of 2026 was a brutal lesson in the dangers of greed and speculative mania. It proved that no asset, no matter how safe its reputation, can protect you when the entire market is built on a foundation of debt instead of real value. The assets might change, the names on the door might change, but the core principles never do. And that leaves us with one final haunting question. Will we actually remember this lesson this time? Or is the market just doomed to repeat this cycle of boom, bust, and collective amnesia all over again?